In this video, I'll cover the Backdoor Roth IRA, which is putting money in a traditional IRA and then converting it to a Roth IRA. I'll also explain how to properly execute a Backdoor Roth IRA in 3 easy steps. Later on, I'll share some pitfalls to avoid when doing a Backdoor Roth IRA and one key advantage of a Roth IRA over other retirement accounts that you probably don't know about. Hi, I'm Noel Lorenzana and I'm an accountant. A Backdoor Roth IRA is a great way for high-income earners to contribute to a Roth IRA when earning too much to contribute directly. As you probably know, a Roth IRA is a retirement account that is funded with after-tax dollars with the benefit of receiving tax-free distributions at retirement. It's a legal tax loophole for high-income earners that actually has the thumbs up from Congress and the IRS. Who is this for exactly? If you're a high-income earner, you can't fully and directly contribute to a Roth IRA if your income in 2021 is above $140,000 of modified AGI or adjusted gross income for single filers and over $208,000 if married filing jointly. Before I tell you about the pitfalls to watch out for, do take note that annual Roth IRA contribution limits in 2021 are the same as traditional IRAs. It's $6,000 for people under 50, $7,000 for people 50 and above. Let's get started. Step 1, make a non-deductible traditional IRA contribution. If you haven't already done so, you'll need to open a traditional IRA with a brokerage company like Vanguard or Fidelity. Step 2, convert the non-deductible IRA contribution that you just made to a Roth IRA. You can either do this yourself online or by calling your brokerage company and having a rep assist you. Do this step as soon as you are able. You don't want to avoid delays as this can result in earnings on the contribution. Step 3, invest the Roth IRA contribution. Your contribution will be sitting in a cash account until you invest the funds. So get to it. That's essentially it. Reporting the Backdoor Roth IRA on your tax return will be covered in another video. It's complicated, and if you have a tax professional preparing your taxes, then you should have nothing to worry about. Just let him or her know that you made a Backdoor Roth IRA contribution and provide them with the appropriate tax forms at tax time, Form 5329 and Form 1099-R. One key advantage of a Roth IRA is that unlike traditional IRAs, there are no RMDs or required minimum distributions for Roth IRAs during the account owner's lifetime, but your beneficiaries must take them, so make sure they know this. If they don't, they'll be hit with a 50% penalty on the amounts they should have withdrawn. Ouch. Let's go over some pitfalls to watch out for. Pitfall number 1. There is one important prerequisite to be able to properly execute a Backdoor Roth IRA using my technique. You cannot have any tax-deferred money in a traditional IRA, SEP IRA, or simple IRA in your name. If you do hold tax-deferred IRA dollars on 12/31 of the calendar year in which you are making the Roth conversion, you'll be subject to taxes when making your conversion and the IRS pro rata rule. It's messy, it's complicated, and I strongly recommend avoiding it. Pitfall number 2, don't delay when converting the non-deductible IRA contribution to a Roth IRA. Delays can cause problems, including earnings on the non-deductible contribution, which you don't want. Complete the conversion as soon as you can. Pitfall number 3, report it properly on your tax return. This can be complicated, and I don't recommend doing it yourself, but you can. I will show you how to report it in a future video by properly completing a Form 8606. In my opinion, it's best to have an experienced tax professional handle this for you. You don't want to mess this up and end up with an IRS letter, then later having to pay someone to fix it for you. Here's a bonus tip. Over-contributing or contributing too much to a Roth IRA. Let's say that you weren't aware of the Backdoor Roth IRA option and made a direct Roth IRA contribution instead. Later you discover that your income was too high, disallowing you from making one. Well, now you have a problem. You would need to remove the excess contribution as soon as possible to avoid an excess contribution penalty. Any earnings would also be taxable and subject to a 10% early withdrawal penalty, and you would likely need to amend your tax return. I hope you found the video helpful. If you did, please consider hitting the like and subscribe button. It helps me grow my channel. I would really appreciate it. If you have a question, leave a comment below. My name's Noel. I help people who don't have their own personal accountant by answering not so common money, business, and tax questions. Thanks for watching, and see you in the next video.